Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to another edition of Zach's Top Stock Picks. I'm Brian Boland. I'm the aggressive growth stock strategist, and I've got a top stock pick, and then we're going to be followed up by Andrew Rocco, and he's going to give his top stock pick. So let's get right to it, shall we? My top stock pick for the week is Texas Instruments, and it's a company that's been along for a long time. I think a lot of people might remember them for their exquisite calculators, that sort of thing. But, it's much more than that. It's really chips, and that's what we're, concerned with. So TXN is the ticker. It's a Zach's rank number 2. That means it is a buy. And it's got a C for growth and a D for value. This hasn't been one of my growth stocks because it's got such a low growth score, but it's a very large company. As we can tell, the market cap is $209 billion. Also pays a dividend. That's one of those signs that you're not going to be big on the growth story because you're paying a dividend. Growth companies typically want to hold on to that cash and reinvest it in the business because they're growing. Established companies like Texas Instruments pay you a dividend to hold on to the stock. So a 2.47% dividend. Hold the stock, get some payment to hold the stock. So, there is all that. So and I selected this because the company is reporting later this week, and I'm pretty sure here it is. It is April 22nd. After the market closes, we're expecting earnings. So I think the Zach's front page here for our ticker quotes, our quote overview page has changed up a little bit. So stole some of my thunder on the chart, but let's just jump right to the numbers that I always love to go over because we have to have the numbers work out first before we actually go into something. So we've got a beat, and coming off of a miss. So I would say two things on this. On an absolute sense, our earnings, have a strong middle and second and third quarter, and fourth quarter, first quarter seem to be a little bit depressed. That's probably a seasonality issue because this is an established company, and we've gone from monster beat 22 cents on an absolute basis down to missing. So we want to see that idea turn around for Texas Instruments here in this coming quarter. And we're hoping for the best here. As always, we want to see everyone succeed. This quarter, it's holding still at $1.37, so nothing much here. We've got a 1 penny estimate revision for next quarter. Not that big of a deal. And for the full year, we're actually down a penny for this year. So I don't necessarily love that. Don't necessarily hate that, but it's 1 penny. We know most companies beat. All right, so for next year, we go from 7.56 up 4 cents to 7.60. So very limited, tight range here on our estimate and the movements. So let's jump ahead to growth because that's where the story's at for me all the time. We're looking at 19.37 billion in revenue, almost double digits, 9.5%, hanging right in there at 9% for next year at a little bit over 20, just about $21.2 billion. So plenty of sales, and that's why it's hard to move the needle when you've got such a big number, but they are moving it to a 9% clip. So we've got steady growth. Investors do like to see steady growth from big names like this. All right, so what are you paying for this stock? You're paying 36 times forward earnings, 12 times book. And this is the interesting thing, and this is where I think it's cheap. Value investors would want to see that price to book be less than 3, but this is a asset heavy business. It takes a lot to make these chips and calculators and everything else. So that's why you're going to have a bigger price to book. We got price to sales at 11 times, and we can see growth in the most recent quarter was 10% on a year-over-year basis. Here's your problem. Its margins in the last couple of quarters have been tightening up. All the focus in the chips has all been, what are you doing for AI? And, I haven't really read Texas Instruments being too keyed into that. Maybe we're going to hear that in the upcoming report on, I believe, Wednesday. All right, here we're taking a look at our price and consensus chart. This is kind of our go-to thing. We've seen 1-2 misses over the last 5 years or so. So It's pretty rare to have a miss. And after the last miss, boy, that stock kept going. And then we got another report, and then a nice move. That's a nice move. So I'm really bad with this touchpad, but we can see here from that miss to the next basically 2 quarters, you could have an opportunity there. Obviously, there's been geopolitical nightmare mess here of what's happening to oil and basically the whole Middle East and nuclear war, maybe. Hopefully not, obviously. But if we get things moving, or getting things moving in the right direction for the stock, we could see a very similar move. So keep Texas Instruments on your radar for this week, because I believe there's a good chance the stock beats and we get things back in order for Texas Instruments and any other stock. All right, that's it for me. Now let me hand it over to my colleague, the ever entertaining and editor of Technology Innovators. It's Andrew Rocco. Go ahead, take it away, Andrew.
Thank you, Brian, and welcome everyone. My name's Andrew Rocco. I'm a stock strategist here at Zacks Investment Research. I also manage the Technology Innovators portfolio here at Zacks. And let's jump into my top stock pick for April 20th. So this is one that we own in the Tech Innovators portfolio. I also do own it personally, full disclosure, and that company is Fastly, ticker symbol FSLY. And it's a San Francisco-based leading edge cloud platform provider with a Zacks rank number 3 hold. And Fastly offers image optimization, security, edge computer technology, and streaming solutions. So it's a little bit complex what they do, but I'm going to try and simplify it for you guys today and let you know why I'm bullish on this particular stock. So investors can think of Fastly as sort of like the Amazon of cloud computing. So if you remember, before Amazon sort of revolutionized the e-commerce market, consumers would order a package off the internet, and there would be a massive centrally located warehouse where that package would come from. And it would take maybe a week or 2 weeks to get your package at a minimum. Now, today, Amazon has these smaller warehouses divvied up throughout the United States, and that allows you to get your package sometimes same day or within a day or two at the very maximum. So Fastly's key innovation does this for cloud computing. So its key innovation is called Points of Presence, POPS, and this technology located in network dense data centers across the country. And unlike legacy content delivery networks, which store and copy images or videos close to users, Fastly's architecture allows developers to run code at the edge of the network where the internet connects directly to the end user. So in other words, instead of needing to access a Google or Amazon data center across the country, Fastly's technology allows users to update global content in milliseconds, even uncatchable content like personalized shopping carts or API responses. And we're going to talk about agentic AI and how Fastly weaves into the agentic AI era here. If we could just get that away from my screen. And really, the early innings of the AI boom were characterized by large language chatbot AI models such as ChatGPT and Gemini from Alphabet. These models have grown dramatically in popularity and driven the massive spending and interest from America's largest tech companies. With that said, agentic AI is the next and likely larger phase of the AI boom. And the reason for this is, unlike conversational AI chatbots like ChatGPT, agentic AI agents can run without human supervision. So in other words, it consists of AI agents and machine learning models that mimic human decision making to solve problems in real time. So just to put it simply, generative AI produces content while agentic AI can perform tasks autonomously. So it's kind of like next level AI, and it's really growing, especially within the enterprise segment. And here you can see that agentic AI is taking off. These are the search queries on Google. And the reason for that is in January 2026, OpenClaw was released, and it's a self-hosted AI agent that can execute tasks directly from messaging apps such as WhatsApp, Telegram, and Slack. And unlike traditional LLMs that merely generate text responses, OpenClaw can read and write files, browse the web, and interact with other applications while running 24 hours a day, 7 days a week. And OpenClaw has exploded in popularity, gaining a mind-boggling 20,700 GitHub stars in a single day. And AI agent integration searches have exploded from just 110 to more than 12,000 in a single month. So here's where Fastly comes in. Fastly benefits from an increase in both agentic and generative AI traffic. So while I'm discussing agentic a lot, they do benefit from increases in generative AI traffic. They kind of help the system to move along much more rapidly. They provide some of the security needed that comes with increases in traffic. So they'll benefit from that perspective. And then Fastly mostly deals with enterprise customers who have deeper pockets, and they tend to be stickier customers. So recently, Fastly delivered a stellar quarter driven by rising contribution from agentic AI, which we believe is still in its infancy. At the same time, customers signed larger deals with Fastly, reflecting broader commitments across network delivery, security, and compute. And it's really an underappreciated play on both large language model use and agentic AI, in my view. So the agentic AI revolution is increasing that network volume, as I said, and Fastly is really at the heart of that because it's going to allow the users, again, to run those models much faster and securely. So let's jump to their forward estimates. And these are Zacks consensus estimates. Essentially, we take all of the estimates on Wall Street, we combine them, and we get our consensus estimate. Those consensus estimates suggest that EPS growth will be triple digits in 2026 at a clip of 115%. And then next year, we see those earnings growing at a juicy 32%. So we're seeing really strong growth there. And then Fastly has a tendency to beat those consensus estimates. So they've beaten Zacks consensus estimates for 12 consecutive quarters and an average of 50% over the past few quarters. And like I said, that agentic AI revolution is just beginning. So I wouldn't be surprised if they begin to start beating these estimates by even more in the coming quarters. And that's really why I'm bullish on the stock. And then from a momentum perspective, really the most potent signal I've studied is relative strength. And relative strength essentially measures how does a stock hold up versus the market. So in February, we had a bunch of tech stocks selling off. Well, Fastly was doing the exact opposite. You could see this big spike. This was post earnings here, and it rallied for a really, really long time. It's up 141% year to date versus just 4% for the S&P 500. So if this market starts to get going, which I think it will once we get this Iran situation taken care of, this stock might even have more momentum from here. But we're not chasing the stock. What I like to see is we're getting this nice pullback, first pullback in several weeks to the 10-week moving average. In my studies and in my trading history, this is one of the best studies is when you get this first pullback to the 10-week moving average. It offers you fantastic risk to reward. So I am a buyer of Fastly here. As I said, we own it for clients. I own it in my personal portfolio. That's ticker symbol FSLY. Thank you guys so much for tuning in. I did want to bring to your attention we have a promo currently running. So if you want to check that out, visit Zacks.com/promo. Again, that's Zacks.com/promo, and have a fantastic week. Thank you so much.